Good morning and welcome. I am Kenny Polcari, your host of the party, and today is Thursday, January 19, 2023. And where am I? Well, just look around. I am at the iconic New York Stock Exchange this morning, filming my daily video. So what is it that you need to know? What happened yesterday and what are the markets doing today? Well, yesterday, the eco data points point to something other than a soft landing, right? They were weaker across the board, but for the PPI, that was actually better. Markets didn't like it. Fed comments are mixed, right? It's 25 basis points or 50 basis points. Are they going to pause or are they going to pivot? Earnings are continuing to beat at the rate of about 72% of the report so far, but be careful, we're very early in the race. Oil, holding, and treasury prices are rising, sending yields on the 10-year plunging. Global markets are weaker this morning. And what are we having for dinner? We're having the steak Pizzaiola, but we're going to get to that in a moment. So what happened yesterday? Stocks initially rallied and then they fell. The Dow ending the day down 615 points or 1.8%. The S&P lost 62 points or 1.6%. The Nasdaq gave up 140 points or 1.25%. The Russell lost 30 points, while the transports gave up 63 points or just under 0.5%. Economic data was front and center yesterday and all points to a weakening economy. New York Fed Services business activity plunged by 21.4. Retail sales month over month down 1.1%. Ex-autos and gas down 0.7%. Industrial production down 0.7%. Capacity utilization at 78.8, down from 79.7. Manufacturing production down 1.3. And all of these data points point to a weaker economy. And then we got the producer price index, the PPI, which should have been the bright spot because it fell more than what the expectation was, which was actually a positive. Month over month, PPI fell by 0.5%. The expectation was down 1/10. Ex-food and energy, it rose by 1/10%, but that was expected. Year over year, PPI rose by 6.2%, but that's below the expectation of 6.8. And ex-food and energy, it rose only by 5.5%, down from 6.2% last month. Now, all of this was music to the Fed's ears. And why? Because it suggests that the Fed's is being successful in stamping out inflation, right? The economy is getting weaker, and that's the positive. But it also suggests that the landing might be anything but soft. Now, it almost guarantees that the Fed will raise rates by 25 basis points on February 1st versus the 50 that some are suggesting. But it still does not guarantee at all that they're going to pause on February 1st. In fact, the market expects a pause after the March rate hike of 25 basis points. I, on the other hand, expect we're going to have 3 more rate hikes, February, March, and May, and then we're going to get the pause by the Fed. And a pause is not a pivot. Comments made by Fed Presidents Bostic, Logan, and Harker seem to favor that view, 25 basis point, while St. Louis Fed President Jimmy Bullard was much more hawkish, saying that he favors a 50 basis point rate hike in February, and that he sees the benchmark Fed funds rate to be somewhere between 5.25% and 5.5% by the end of this year, right? Current rates are now 4.25%, 4.5%. That, as the market expects rates to be 4.9%, so clearly there's a disconnect. And that's all the headline needed to be, and stocks started to move lower. Recall, Minneapolis's Kashkari also favors higher rates, 5.4%, and he told us that 2 weeks ago, right? And what Bullard and Kashkari are hinting at is basically another 100 basis point hike in the Fed fund rate before they pause. The smart logic algos, that's all they needed to hear. They operate by scraping the headlines and interpreting the meaning. They shifted quickly from the buy mode to the sell mode, and down we went. Stocks, which were positive until 10:20 in the morning, broke the flat line and then traded lower for the rest of the day, ending on the lows of the day, which typically means that we're going to test lower again this morning. And U.S. futures are pointing in that direction, confirming as Dow futures are down by 150 points, S&Ps were down by 20, Nasdaq lower by nearly 75 points, and the Russell off by 15 at 5:30 this morning. Microsoft, a key name in the large cap tech growth sector, added to the sour mood by announcing that they plan to lay off 10,000 people as they prepare for the ongoing economic slowdown, right? In his blog post, CEO Nadella told employees that it is the shaky economy that's driving this move, saying that companies globally had begun to exercise caution as some parts of the world are in a recession and other parts of the world are anticipating one. The move will force them to take a $1.2 billion charge against earnings that are due out on January 24th. And this news, along with the broader market weakness, sent Microsoft down 4.5% to end the day at 235.81. Now, you could also point to the charts to explain the reversal. The S&P had been kissing the long-term trendline resistance, the 200-day moving average, for a week now, while also testing the trend line drawn from the highs of January 22 right down to the highs of yesterday. As you can see, that trend line is very clear, and it suggests further downside ahead. But this should not be a surprise at all, right? We've been talking about it. We've been talking about it for months now. More volatility and more downside ahead, at least for the first quarter, if not into the second quarter. The range that we are in now appears to be 3,800, 4,000 on the S&P, and if we pierce 3,800, then it sets us up to potentially test the October lows of 34.90. Also, remember, Morgan Stanley and Goldman Sachs are still in that camp of S&P 3000 before this is over, right? Saying that forward earnings guidance is still too rosy, and they suggest we'll see further pressure to the downside. Earnings season, which began last week, has gotten off to an okay start. 72% of the reports so far are beating the lowered estimates. And the ones that aren't are really getting punished. Think Goldman Sachs, what they did to that stock the other day. But we're still very much at the beginning. We've got another 3.5 weeks to go before this beauty pageant is over. Look for earnings today from M&T Bank, Procter & Gamble, Truist Financial, Key Bank, and Fastenal, all before the opening. And after the opening, we get Netflix and PPG. Tomorrow brings a slew of others, Schlumberger, Ally Financial, State Street, Legend Pharmaceuticals, so there's a whole bunch of them. Eco data today includes housing stats month over month, expected to be down by 4.8%. Building permits month over month expected to be up by 1%. Philly Fed expected to be a negative 11, but after what we've heard, we could expect that to be even weaker. And initial jobless claims and continuing claims are the typical Thursday reports. Treasury prices rose, sending yields lower in yesterday's action, and this suggests that investors do not believe what the Fed is saying at all. They are betting that the Fed will not only pause, but will pivot and cut rates before the end of the year, something J.J. Powell has been very clear about, and a host of the other Fed members have been saying, right? It's now a game of chicken. We're going to see who caves. Is it the Fed or is it all these speculators? And while prices rose, the curve in the Treasury curves remains inverted, which continues to point to the coming recession. 3-month treasuries are yielding 4.49%, 2-year treasuries yielding 4.06%, and the 10-year is now yielding 3.36%, and that's the one to watch in terms of what the bond market is telling you. The bond market, as Jeffrey Gundlach pointed out last week, is what investors need to pay attention to rather than what the Fed says. In fact, Gundlach said, essentially, that the Fed and its members are clueless. They don't have an idea of where we're going. He sees rates peaking out at 4.9% by late spring, and then he sees a pivot in the fall. Oh boy, this is getting very interesting. Oil continues to churn in the high 70s. This morning it's down 90 cents at 78.56 a barrel, sitting right on the trend line. A failure here could see oil test to the low 70s once again like it did earlier this month, but my gut says I don't think so. I think it holds here. Every sector yesterday was lower, with communications, XLC, down 1.2%, while consumer staples, XLP, lost 2.7%. The contra trades, the ones that get you short the market, all rose. Makes sense. The SH was up 1.5%, PSQ up 1.4%, and the DOG was up nearly 2%. The value trade, SPYV, was down 1.7%, while the growth trade, SPYG, lost 1.4%. Now, if you are bullish by year end, then the move would be to get out of the defensive names, the stuff that people need. So you would want to get out of staples and healthcare and youth and energy and move into the sectors that had gotten clobbered last year and will provide excitement on the upside this year. So think consumer discretionary, communications, artificial intelligence, semis, tech, real estate, home builders. But I'm not there yet. I mean, they should all be part of a well-balanced portfolio anyway, but I would continue to overweight the stuff that people need, the defensive names, and I would underweight all the others until monetary policy becomes clearer and we have a better picture of what the landing looks like, soft or hard, right? That's how you have to kind of position this. So I would also make sure that you have some mid-cap value, which you can play with the IJJ ETF, or the small cap value, which is IJT, as part of your portfolio. European exposure can also be achieved easily with the ETF FEZ. That's the Spider Euro Stocks 50 ETF, and that's up 10% so far this year. European markets this morning were all lower. The FTSE down 0.9%, the CAC 40 down 1.4%, the DAX down 1.2%, Eurostox down 1.3%, Spain lower by 1.5%, and Italy off by 1%. Comments out of the World Economic Forum are expressing further weakness. Christine Lagarde says inflation is way too high and the ECB will maintain its course. As I pointed out, futures are lower and they are going lower, so take your time. No reason to chase anything, right? Let them just come to you. In this case, patience is a virtue. Boston's Susie Collins and New York's Johnny Williams appear on the commentary front today, so expect commentary from them. The S&P closed the day yesterday at 39.28. And futures weaker this morning, we can expect to pierce the 50-day moving average trend line at 39.18 and look to test the 100-day at 38.70. A failure there will light up the algos, putting more pressure to the downside. Okay, so now what are we having for dinner? Well, we're having the steak Pizzaiola tonight. It's another hearty and heartwarming meal. It's not that difficult to make, but it might be a little expensive because meat is not coming down in price. For this, you're going to need just a couple of things. You need a nice ribeye or a T-bone, right about 3/4 of an inch thick. You need olive oil, oregano, garlic, onions, red and green bell peppers, a can of crushed tomatoes, not puree, just crushed tomatoes. You need some red wine, salt, and pepper, right? And you can use some crushed red pepper flakes if you want. That's optional. Now, in a big saucepan that's going to be able to make the sauce and then hold the steak, you want to heat up some olive oil and add the crushed and sliced garlic, move it around a little bit, let it brown up a little bit until it's nice and golden. Now you're going to add the sliced white onions and the julienne bell peppers, right? You're going to slice those nice. Turn the heat to medium and cover it. Let the onions and peppers cook until they're soft. Maybe it's 5 to 8 minutes, right? Now you're going to add the can of crushed tomatoes, the oregano, and the red pepper flakes if you're using them. Turn the heat up high. Bring it to a quick boil and then reduce the heat to medium. Add the red wine, probably about a half a cup, salt and pepper, and then let it simmer and thicken up. It should take 10 to 15 minutes. Don't boil it, just let it kind of simmer. It'll thicken up. Now you're going to rub the steaks, right, with olive oil and salt and pepper, right? Don't drown it in oil, just massage the salt and pepper into it with a little bit of oil, just enough to prepare them for the skillet. Now you want to take separately, you want to take a skillet, heat it up to really high, add the steaks so that they sizzle. A ribbed pan skillet works really good here. You can sear them for about 4 minutes on each side, 4 minutes on one side, then flip them over 4 minutes on the other side. Now, take the steak and add it to the other skillet that's got the tomato sauce and the onions and the peppers in it. Let it sit in there for about 10 minutes simmering, right? Keep it covered. This is going to give you a nice medium steak. If you prefer, you can let it simmer longer and then the steak will be more well done. But in this case, I think you want a nice medium steak. When you're done, you're going to remove the steaks from the skillet. You're going to slice it into strips and arrange it on the plate. It should be enough to feed 4 adults if you use 2 nice sized steaks. Next, you want to stir the sauce in the skillet pan a little bit just to deglaze it off the bottom, making sure that you scrape the bottom of the pan to get all the little bits at the bottom. Now, take the sauce and spoon it over the steak, and you want to present this meal with a large mixed salad of maybe arugula, Boston beef, romaine, topped with tomatoes, red onions, cucumbers, dressed in a red wine vinegar. And for the wine, I would use the Brunello di Montalcino, and that's probably the same one you should use when you actually cook the steak, because it's a perfect, heavy, really velvety wine. It's perfect for this dish. Listen, it's raining out here in New York City, but it's going to be a very interesting day. Until tomorrow, take good care.